So, welcome everybody to our 12th academic debate at the EBI. It's a very interesting debate because for once we are not speaking about banking regulation, not about banking resolution, not about deposit guarantee schemes, but this time we will focus on a totally different topic, which was up to now not on our plate, on our agenda, but good coincidence occurred, and some months ago we accepted as one of our fellow academic members, our dear colleague Ruth. And when we discussed about potential events, Ruth proposed this topic on bank-customer relationship in the realm of private law, and in particular the bank's fiduciary duty. And she set up an excellent panel. And we have the pleasure today to discuss this issue with Ruth. We make the first presentation, and then with our dear friend and colleague and member of the academic board, representing the University of Vienna, where he is currently has his tenure. And with great pleasure also, Sandra, Annette, who is speaking from Singapore, correct? Where Sandra, thank you so much for being here. I will not be late because you will have to go to sleep, yeah, at some point. But we accommodated the time so that you can be with us, yeah, without staying sleepless. And you are the Deputy Director of the Center for Banking and Finance Law at the National University of Singapore. So thank you very much all for having taken the time to prepare yourselves for this event. Thanks to all who are attending, and in particular, many thanks to you, Ruth, for having taken this initiative and set up the panel. And immediately the floor is yours.
Thank you very much, Christos, for the introduction and the kind words. I will share my presentation. So, as Christos mentioned, I will present today the Israeli approach of the bank's fiduciary duty. Actually, this is a unique approach. I'm not familiar with any other jurisdiction that has adopted a similar approach, a similar model. The Israeli approach has evolved over the years, and I'm happy to say that I contributed to its development. The Israeli Supreme Court quoted my writing on the matter, a 700-page book and many articles, and adopted the conclusions and views that I expressed in a few important precedents. So I'm very happy, very grateful for the opportunity to present the Israeli approach in this debate today. As the first speaker, I would like to start with explaining the exact meaning of the bank's fiduciary duty, because some jurisdictions tend to mix it with to confuse it with other similar duties or notions, such as the duty of good faith or the duty of care. Well, the duty of good faith only means that the bank must act honestly and fairly. The duty of care means that the bank must act professionally and without negligence. But the fiduciary duty is much stronger. It is underpinned by the duty of loyalty. The bank, as a fiduciary, must act with utmost loyalty towards the customer. It must act in the best interest of the customer. The bank, as a fiduciary, must protect the interest of the customer, and moreover, it has to prioritize the interest of the customer over any other interest, including that of the bank itself. So obviously, this is a very onerous, a very stringent duty, and it is difficult to put it into practice. So, speaking about the Israeli approach, the Israeli courts imposed a very wide fiduciary duty on the banks in a few aspects. Firstly, the duty applies to each and every customer and not only to vulnerable customers. Secondly, the duty applies to the diverse range of services and to the whole spectrum of banking activities. And this is an important point because in other jurisdictions, the duty may apply only in the fields of investment advice or financial advice. And thirdly, the duty applies automatically, no special circumstances are required. So how did the Israeli court arrive at the decision to impose such a wide fiduciary duty? What were the rationales for such a duty? So the Israeli courts were bothered by the huge disparity of power that exists between the regular average customer and the bank. And by the way, I am focusing today on the retail sector, the fiduciary duty towards the retail sector. So there are huge differences between the parties in the financial power, in the bargaining power, in the technological abilities to manage and monitor the accounts. There are vast differences in the level of professional knowledge. Another problem is the information asymmetries in respect of the banking products and services, which enable the bank to offer the customers services and products that do not meet their needs, do not necessarily meet their needs. And another issue is that customers tend to have cognitive biases, such as over-optimism, that lead to imperfect choices and financial mistakes when choosing banking services and products. But a disparity, and even a huge disparity of power between the parties, is not a strong enough justification for imposing such a wide fiduciary duty. And indeed, the Israeli courts also referred to the special characteristics of the bank services. We all know that the bank services are extremely complicated. They are vital services. Nobody can manage today without a bank account. And so the impact of the banks on the life of each and every person and even businesses is enormous, is considerable. So the result is a severe inferiority of the customer and a strong dependency of the customer upon the bank. And the fear or the concern of the court is that the bank may take advantage of the situation to the detriment of the customer. The inferiority of the customer and the dependency leave the customer no choice but to rely on the bank. And here we come to the third justification for imposing such a wide fiduciary duty. And this is the trust and confidence that customers place in the bank. Customers tend to have special confidence in the bank, and usually they do not seek any second opinion before acting according to the bank's advice. Customers expect the bank to act with a high level of fairness and integrity, and they expect the bank's officials to act in their best interest. And let's admit it, the bank is not only aware of this situation, but also encourages it. And finally, I will mention another justification for imposing such a wide fiduciary duty. The Israeli courts ruled again and again that the banks are actually quasi-public bodies. The courts explained that the banks serve as a pipeline for transferring government loans to the public. They serve as a vehicle for implementing government policy. The banks provide vital services to the general public, and the banks actually rely on the backing of the Bank of Israel to secure the deposits of their customers. And this is a very important point because in Israel we do not have an insurance, a deposit insurance. And in cases where Israeli banks collapsed, the Bank of Israel intervened and compensated the customers ex gratia. So if the banks are considered as quasi-public bodies, the expectation is that they would act in very high level of behavior. So, according to the Israeli approach, the purposes of the bank's fiduciary duty are three. Firstly, to curb the power of the bank and guarantee that it is not abused to the detriment of the customer. Secondly, to justify the customer's legitimate expectations that the bank would act fairly and in their best interest. And thirdly, to instill norms of ethics in the banking activity, and I will return to this point a bit later. So, what can be the practical implications of the bank's fiduciary duty? I will give you a few examples. By virtue of the fiduciary duty, the wide fiduciary duty, the banks are subject to a wide duty of disclosure and explanation. And I will explain this point. Under the principles of the general law of contract, there is no obligation on one party to a contract to explain the content of the contract to the other party. A person who signs a contract without fully understanding it bears full responsibility. He or she will not be able to cancel the contract or to shift liability to the other party. But when we speak about the fiduciary duty, the bank's fiduciary duty, the bank has to proactively provide explanations to the customer even if the customer never asked for them. And this is especially true for in risky transactions, such as mortgages, certain loans, providing collaterals, signing guarantees, etc. Moreover, the bank has to make sure that the customer understands the full repercussions of the transaction. The fiduciary duty may also be relevant, very relevant, to customers who encounter financial difficulties. Under the fiduciary duty, the bank should show flexibility and lenience and consider leeways. For example, if a customer finds it difficult to repay a loan, the bank should consider extending the loan over a longer period of time, thereby decreasing the amount of each repayment installment, for example. This idea was very relevant during the pandemic period, when, due to lockdowns, many people had to stay at home, could not work, businesses were closed, employees were fired or sent on furlough, and many people could not repay their loans. The supervisor of banks at some point stepped in, intervened, and published an outline of reliefs. But until this took place, there was a real public expectation that the banks show flexibility in this regard. The fiduciary duty may impose on the banks rules of responsible lending. The bank should refrain from providing credit to customers who clearly lack repayment capability. The bank should refrain from pushing loan to customers, and they should avoid the transactions that may lead to over-indebtedness. Speaking more broadly and not necessarily on loans, banks should avoid aggressive marketing and convincing customers to purchase products they do not really need. And the bank should avoid offering any financial products that are not aligned with the needs of the customer. The fiduciary duty may also be relevant in respect of bank fees. If, for example, it is possible to carry out bank transactions in two different ways, one of them involving lower fees, and I give this example because in Israel, the fees, especially in the retail sector, the bank fees are very, very high. So if there is a possibility to carry out a bank transaction in two ways, one of them involving lower fees, the bank should proactively inform the customer about it and let him choose the option bearing the lower fees. So these were only examples to show you the content and the implications of a very wide fiduciary duty. The Israeli approach of the bank's fiduciary duty is consistent with emerging doctrines like CSR, corporate social responsibility, or ESG. Under these doctrines, corporations in general, business entities bear social responsibility. This means that despite the goal of maximizing profit, these entities should take into consideration the interests of other stakeholders, like creditors, employees, customers, and even the general public. And this concept is particularly true for banks because of their central role in the economy, because of the vital services they provide, and because of the significant impact that the banks have on the society at large. So consequently, the banks may be considered not only as financial institutions, but also as social agencies with a unique responsibility, social responsibility to their customers. And this idea is compatible with the Israeli approach of the bank's fiduciary duty. And my last point is about supervision and ethics. Financial regulators in many countries understand the importance of ethics, of ethical banking, for restoring public confidence in the banking system and contributing to its resilience. And so many regulators mandate the banks to adopt a culture of ethics. Here we see a kind of illustration that was published by the Dutch Central Bank, and it shows us the components or the topics of bank supervision. So on the left-hand side, we see the traditional topics such as risk management, stress testing, anti-money laundering, etc. But I think that more interesting are the components on the right-hand side. Here we see topics like benchmarking, business models, and this is my point, behavior and culture. Here, behavior and culture. That means that today regulators understand the importance of ethical banking culture. And this is compatible with the idea of the bank's fiduciary duty, which imposes a very high standard of behavior on the banks, actually an ethical standard. So in conclusion, I believe that the Israeli model of the bank's fiduciary duty is the most suitable vehicle for protecting customers. And I want to clarify it. The fiduciary duty under the Israeli model is not an altruistic duty. The banks are not expected to totally neglect their interest. All the fiduciary duty requires from the banks is to act in an ethical, professional manner, as may legitimately be expected by the customer. And I believe that the fiduciary duty under the Israeli model may alter bank practice in a positive way and lead to the creation of an appropriate bank culture. Thank you very much.
Thank you very much, dear Ruth. That was an excellent presentation. I have a couple of questions here, including whether under these conditions Israel could one day join the European Union and whether all this is compatible with European Union law, especially when I hear that banks are a vehicle for implementing governmental policy. But again, thank you very much. There is a food for thought here, yeah? And I will not intervene right now, but I will give the floor to my dear friend Matthias.
Thank you very much, Christos, and also thank you for Ruth for this excellent presentation, really extremely clear. I have not prepared a presentation, and I could excuse myself by saying this is because we don't have fiduciaries in Europe, in the civil law jurisdictions, at least of Europe. Of course, we have in the common law jurisdictions like Ireland, Malta, but we don't have them in the civil law jurisdictions. But that, and I could end the presentation with that, but it's a little bit more complicated. So let's start first with the common law. Why does the common law have these fiduciaries? Perhaps that's a good starting point. I think the archetype of the fiduciary is the trustee. The trustee is really the person that has fiduciary duties and where these fiduciary duties were most spelled out. And we don't, as you know, most civil law jurisdictions don't have the trust. Some of them have introduced similar constructions, like France has a fiducie, for instance, which is modeled on the trust. But if you look into the civil code provisions on the fiducie, the fourth book of the civil code, the French civil code, they only have a single provision on the liability of the person running the fiducie, but they don't spell out these duties. So it's not a very strict regime. And since we don't have, and the trust itself in the common law, I should say, it developed because of the principle of equity and the division of the common law into the common law itself and equity, which we also don't have. So no equity, no trust, no fiduciary. I could say that's why we don't have it. That doesn't mean that we don't have similar things. I mean, things that produce similar results. So, for instance, in corporate law, we often speak of the duty of loyalty that you also mentioned, that directors have towards the company. And this, in my sense, is closest to fiduciary duties, but that is, of course, not a bank. The bank itself, it's the directors of a bank to the bank, but also of any other corporation. You could say that is quite similar. Then we have a very particular thing in Germany. We have a fiduciary collateralization. So you can provide collateral in an outright transfer. You transfer all of your property or full property in a certain object to another person, a collateral taker. And then this collateral taker becomes the full owner of this. And this person then, this collateral taker, is considered in Germany, and we really use the term, a fiduciary and Treuhänder, to use the German term, who owes duties. But at the same time, difficult to compare again with the common law, because we don't have equitable ownership, no tracing, nothing like that. So if this person, if this collateral taker transfers this property to somebody else, to a third person, the third person will become owner, free of any charges, free of any rights. And that's different to the common law, where you have these beneficial ownership and tracing possibilities for the beneficiaries of the trust. Now, when it comes to contract law, and that's the area that you are focusing on, contracts with banks, you mentioned already that we have the duty of good faith, very typical for German law, but now also reinforced since the reform of the French law of obligations a couple of years ago, also in French law, as a very important principle. And you already made the point that the duty of good faith is not the same as fiduciary duties. I totally agree, because the duty of good faith applies to any kind of contract, not just to contracts with a specific content or with a specific person, but to any type of person. However, the duty of good faith is a continuum. It can be weaker and it can be stronger. It's like a sliding scale. And the courts in France, Germany, and also in other civil law jurisdictions have sometimes tightened the vices a little bit on certain persons, especially for the reasons that you mentioned, superior knowledge, bargaining advantages, informational asymmetries, behavioral mistakes on the other side. So precisely these reasons were used and cited to justify why some co-contractors have more duties of good faith than other, why it is sometimes more stringent than in other cases. And I can give you some examples where this was where the results were even stronger than I would say a common law jurisdiction would have reached. I know that Israeli law is a mixed jurisdiction, so you have elements of both, but on this point, I think you go with the common law. The civil law I want to show can also be quite strict when it comes to these duties of good faith. So one example taken from German banking law is the German federal court assumes that whenever a bank gives advice to somebody who must not even be a customer, a bank gives any advice, there is always immediately a contract entered into with this person to which the bank gives advice. So I'm calling a bank and I'm not a customer of the bank and I'm asking, what's the euro-dollar exchange rate today? And they give me wrong information. A court in Germany would assume that at that moment when I call the bank and they answer, a contract is entered into and they are liable for any false information that they give. I think that is even stronger than in the common law because you don't even have any consideration that is given here. I don't make any promises. I merely ask for information and the courts assume contract is closed and liability ensues. Another example is a case on derivatives. A number of banks have sold derivatives in mostly Anglo-Saxon banks have sold derivatives on the European continent and very complex structured derivatives and to non-professional clients. And these misfired and went wrong. And the German federal court in one case has, in a seminal case, has held a bank liable for selling these derivatives because it would have violated the duty of good faith by not informing the client. And now pay attention to the details, what you have to inform. By not informing the client about the risk profile of this product, of this specific derivative, every information it has about this derivative and the underlying, on which this derivative relies, and most importantly, also on all the profit margins that the bank makes on this contract. So the bank would really have to disclose the whole internal calculus on how they priced this particular derivative. I think that's a decision that would have never been taken by any Anglo-Saxon court, but it was based on the very old and very time-honored duty of good faith. So all of this to say, the duty of good faith may not be as strict in general as the fiduciary duty, but it can be as strict. And finally, to speak of the European Union a little bit, the European Union, as you probably know, doesn't intervene much in the private law, it leaves that to the member states, but it has in the MiFID II, it has some provisions, of course, that you could interpret as providing some kind of fiduciary duties where, for instance, an investment firm, when it advises on certain products, it has to act in the best interest of the client, there are these rules on best execution and so on, but these are pinpointed rules on particular aspects and no general fiduciary rules. So to sum up, I would say we don't have the fiduciary concept, not only the term, but also not the concept, I must say. We reach similar results sometimes. There is this debate in the literature whether the legal origin, whether is responsible for the performance of the banking and financial industry. And the point is made that the Anglo-Saxons have in certain respects more stricter rules than the civil law, and that has been in a number of studies had been cited as a reason why banks in Anglo-Saxon countries are more successful and the whole financial system is working more efficiently. I wouldn't personally say, when I look at the evidence that I have before me at least, that the lack of the concept of the fiduciary is the main reason or the explanation why the common law is superior. I think you can also manage it with other tools, but I grant you, especially the last slides that you showed, that this fiduciary concept is extremely rich and that it can even be used for new developments, as you cited, like CSR, ESG, and so on. That's quite interesting, I must say. We would struggle with this, I would say. Perhaps we could integrate that also in the duty of good faith, but it would be difficult. Thank you.
Thank you so much, dear Matthias. After Sandra's presentation, the first point I would raise is that to Ruth and then to yourself, is that most of the points that Ruth presented on the entire spectrum of financial services resembles very much to MiFID II when it comes to investment services. And I would have asked you if I understood it correctly. And you already covered this. Nevertheless, just one brief point, and this is a major issue for discussion further on, is that, as I understand it, the MiFID II, if you translate the rules into national law of the member states, yeah, it's still a directive. It's more of administrative law, meaning that it is leading to the imposition of administrative sanctions. So my question in that respect would be to what extent you have a spillover effect, yeah, from administrative law into private law, and in general, what is the Ruth, this is just for you to reflect, what is the sanctioning regime in case of violation here? Yeah, is it direct claims against the bank in civil courts? We can discuss it. But before we do that, we have now our third distinguished speaker. Sandra, you have the floor now.
Thank you. Thank you very much, Christos. I want to say it's a great pleasure to be with you here today, and I enjoyed my fellow panelists' presentations very much. I'm going to now share some slides. I'm going to be talking about the common law position, and of course the common law, I suppose at the center of the common law, or historically, is England, but of course the common law has been exported or adopted in many other countries, including my own jurisdiction, Singapore, as well as numerous other jurisdictions. Matthias referred to Ireland, and of course Australia, Canada, New Zealand, and quite a few others. I'm going to be speaking primarily from an English position, although at a broad level there is a lot of common ground between the different jurisdictions, but of course they've all diverged a little bit as well, so they're not identical. So there is, I'm also just going to start with what the content of fiduciary duties, and there's a lot of overlap here with what Ruth said. My first point might seem a little bit obvious, but I'll explain why I make it. And that is that a fiduciary is someone who owes duties that are fiduciary in nature. The point is that it's not the other way around. So it's because you owe fiduciary duties that we say you're a fiduciary. We don't say you're a fiduciary and then work out what the duties are. It's the duties that come first. Now, I think probably the leading case, and of course the common law, the primary sources are judicial pronouncements, is from this case of Bristol and West Building Society and Matthew. And in this case, the court said a fiduciary is someone who's undertaken to act for on behalf of another, which gives rise to a relationship of trust and confidence. And the distinguishing obligation is the obligation of loyalty. So it's not the only obligation, and Ruth went into more detail, but this is the distinguishing obligation in the common law. There are a number of facets. It is considered to include a duty of good faith, a duty to avoid conflicts of interest, a duty not to make a secret profit. But there can be no comprehensive outline of what fiduciary duties are. To some extent, it'll depend on the circumstances, and not all fiduciaries will owe identical duties. Now, a fiduciary will also owe a duty of care, but I think probably the consensus is, but of course academics don't agree on this, and maybe the courts haven't been totally consistent, that the duty of care is not part of the fiduciary duties, but as a fiduciary you are going to owe a duty of care. Now, in the common law, two types of fiduciary relationship are recognized. The first is what we call a status-based relationship. And examples of those are the solicitor-client relationship. Because you're in that relationship, the solicitor will be a fiduciary. And the other one has been mentioned by Matthias. It's probably the most well-known, the trustee-beneficiary relationship. Now, it's very well settled that the bank-customer relationship does not fall into this category of fiduciary relationships in the common law. But the other type of fiduciary relationship is fact-based. So it depends on the facts of the particular relationship as to whether fiduciary duties arise. And usually those duties arise because they've been assumed by the person whom we call the fiduciary. And it is possible for a bank to be a fiduciary as a result of having assumed those obligations in a particular relationship. I'll say a little bit more about that later. Now, there is a separate type of liability that banks can incur, which is not fiduciary, which goes by the perhaps misleading label of a constructive trustee. But this is quite distinct from being a fiduciary, so it's not to be confused. It arises because of the bank handling trust monies in a way that's inconsistent with the interests of the beneficiaries. But those are not fiduciary duties. Now, talking about the potential for banks to be fiduciaries, elaborating on that point, as I've already indicated, banks are not status-based fiduciaries. So the provision of banking services, it's accepted, banks will pursue their own interests. And I'm right now focusing really on the core services of deposit taking and lending, and I'm going to say something about payments as well, which I think in the retail context make up the core of banking services. Certainly a bank will not ordinarily be a fiduciary in providing any of those services. Now, some people may have heard of a new duty that's been introduced by the regulator in the UK, the Financial Conduct Authority, called the Consumer Duty. And this Consumer Duty is very new. It came into effect this year. This requires banks, to prioritize consumer customers' interests when they render their services. But it's been made explicit that this is not to be seen as a fiduciary duty in the common law sense. Now, I said I'd say something more about payment services. When the bank provides payment services, making payments, receiving payments, it generally will act as an agent. Now, an agent is very commonly a status-based fiduciary because they have so much scope to affect the interests of the principal by binding them to obligations, usually contractually. However, when a bank executes payment instructions, and this might be so for other types of agents too, it has very limited scope to do anything other than to pay as it's been instructed to do. So pay this amount to this person at this account, and that is what the bank must do. There's no choice, no discretion involved. And that fact suggests that also in the payment context, despite being an agent, that there is no fiduciary relationship. And this is a sort of a side point. It's not a point that responds to the fiduciary question, but the UK Supreme Court, the highest court, has recently ruled that a bank has only a very limited duty of care when processing payments. So if they have, reasoning from there, this, I think, supports the view that as a payment agent, the bank is not in a fiduciary position, because if they have a very limited duty of care, which they have more commonly than a fiduciary duty, the chances that they'll owe fiduciary duties are very slim. Now, when might the bank indeed be a fiduciary? Because I said they can be fiduciaries. So there are two main situations where banks have been considered to be fiduciaries. The first is, and this cropped up also in, I think, Matthias, I think you mentioned this for German law. Ruth, you might have mentioned this too, but of course your duty is very extensive. When a customer gives security for another customer's loan, banks have been found to be operating in as a fiduciary because they are considered to owe certain obligations to that customer. However, the modern trend is not to use fiduciary duties in this context. So although it's been done before, we've seen the courts move away from that line of reasoning and to use another area of law, which we call undue influence, which is also part of the body of law called equity, which Matthias also referred to, but it's got no connection really with being a fiduciary, and you can be found to have exerted undue influence irrespective of being a fiduciary. In fact, most people who are found to have exerted undue influence will not be fiduciaries. That is not really a good representation anymore, I think, of when a bank might be a fiduciary. But the other one is in financial advising, and this has been mentioned already by my co-panelists. So I'm going to say a little bit more about this, that this is the area of law, I think, probably where we're seeing banks being considered to be fiduciaries more often. I haven't done an empirical study, but there seems to be a trend. And there's a well-known case, quite old now actually, in English law, Woods and Martin's Bank, a very sort of ordinary situation where a customer, after inheriting money, went to the bank and said, can you help me invest this money? And the bank said, yes, why don't you put it into the business of, they didn't say that in quite this detail, of another customer of ours who owes us a lot of money. Well, they didn't tell him that part. He did that, and the business, of course, didn't prosper, and he lost all his money. And the court did recognize fiduciary duties in that context. There's a little bit of history to all that as well, that maybe other developments in the law at that point are the reason why the court turned to fiduciary duties, and the law in these other areas has now since developed. But still, I think it shows this willingness to recognize fiduciary duties in the financial advising context. And I've just cited there as well also a Singapore case which found fiduciary duties in in a financial advising context. Still in the financial investment services, wealth management context, a bank may attract fiduciary duties if it exercises discretion over a customer's portfolio. So if the bank is managing the portfolio and making decisions about buying and selling, then that would generally be quite fertile for the recognition of fiduciary duties. But notice I say subject to contrary contract terms. Then just to move away from what is really the law, but to, if you like, academic opinion, of course, you get a wide range of views here. Some people don't agree, don't see the need for fiduciary duties in the banking context, but there is some academic support as a matter of policy for banks to be considered fiduciaries at least in the financial advising investment services context. But I think some academics would even say generally, as perhaps now is we've learned, is the position in Israel. So I want to say something about avoiding fiduciary duties. And this is a point actually which I'd be interested to hear from Ruth as to whether this is possible in Israel. And I'm guessing that it's not. But given that banks can be fiduciaries, because of the way they behave and because of perhaps the vulnerability of the customer that they're dealing with, the dependency of the customer on them, and so on, given that they can be fiduciaries, it's significant that they can also avoid assuming those duties. The one way is to make full disclosure of their interest in any transaction and to obtain a customer's consent. So if they say, well, this is what this is the stake we've got, and are you agreeable to this? Then that will be considered to be a consent to the bank making a profit. And at least a reduction, I suppose, in the obligation of loyalty. But of course, that kind of disclosure can be problematic because of the bank having also a duty of confidentiality, and there's a risk that there can be a conflict between those two things. But the more general way for banks to avoid fiduciary duties in the common law is to insert a term into their contracts with their customers, and usually that will be a standard term, so it's part of the small print, and this will make it clear that the bank is not assuming any fiduciary obligations. Now, those provisions have been upheld, but the validity will be subject to some controls, such as contractual interpretation. The court might adopt a restrictive approach to try and keep that kind of disclaimer within limits. They might recognize any subsequent oral variation or a variation by conduct that the bank has indeed become a fiduciary. And then there are some statutory controls which might also help to keep these kinds of disclaimers in check, particularly in the consumer context. But between advised commercial parties with relatively equal bargaining strength, this kind of disclaimer in a contract is generally effective in the common law, and has been upheld in numerous cases. And that brings me to the end of my presentation. So I'll just stop sharing my slides and look forward to the discussion.
Thank you so much, Sandra. You brought into the discussion so many new concepts and notions. And as a matter of fact, I'm curious now, after we finish this, I will go to read this Woods versus Martin Bank case, because I want to understand what happened there. Yeah. It looks a little bit bizarre what the bank was proposing, so I will check that. Yeah. So thank you very much all. we do not have a very numerous set of attendees, but still we have some very knowledgeable persons like Daniel and Stefano and Hossein. Welcome all. But the most striking here is that 52% of the attendees are Greeks. So there are two explanations to that. Good friends of mine, a colleague of mine, a dear colleague of mine, the same department, some students of mine. So there are two explanations here. The one is that 1 or 2 months ago I was absent. Matthias was in Athens, so everybody wanted to hear again Matthias. A second might be that they are very much interested in the topic itself. So eventually, before they invite you in Greece, I will invite you in Greece next time, all of you. Yeah, I think Ruth and Sandra, you have made here a market, and Matthias has already. So a combination of that means that we eventually should have something in the future, because apparently it's an extremely interesting topic, which can be discussed in terms of principles. But again, it can be discussed in terms of implementation. In that respect, we still have 25 minutes. I would suggest to the attendees to ask any questions they wish. Yeah. And before I say my questions, I don't know whether you yourselves would like to address a question to one another. I have a lot, but I give you the right of first action or refusal. Yeah.
Okay. Yes, I will start. First of all, I would like to add a few points to my presentation after hearing my colleagues. I referred in my lecture to the case law fiduciary duty, which was developed by the Israeli courts and our Supreme Court. However, speaking about financial advice, investment advice, and in Israel, banks are also authorized to provide pension advice. So we have laws which are more or less similar to MiFID, and these laws expressly impose fiduciary duties on pension advisors and investment advisors and the portfolio managers and people in the field. So these laws include an express statutory fiduciary duty, but this is not unique because it resembles us the MiFID, and I believe that other jurisdictions have similar laws as well. The uniqueness of the Israeli approach is the case law fiduciary duty, which, as I explained, is extremely broad. So this is one point I wanted to make clear. I would like to thank my colleagues, Matthias and Sandra, for very, very interesting presentations, and I do have some questions. First of all, to Sandra, you mentioned the English very new consumer duty. And when I read this consumer duty, and it includes very detailed obligations imposed on financial entities, I had the feeling that this is actually a fiduciary duty, because you have to put the interest of the customer in the center of the bank's activity. It is true that it expressly notes that this is not a fiduciary duty, but I had the feeling that nevertheless it reflects the content and the notion of a fiduciary duty. So I would be happy to hear your opinion about it.
Absolutely, I agree with you. And I think that's why there's an explicit statement that it's not a fiduciary duty. So I think the significance of this is that the consequences of breaching a fiduciary duty will not flow from any breach of the consumer duty. And so I think that as much as it might look like a duty of loyalty or a duty to prioritize the interest of the customer. I'm not sure it goes quite that far that you have to prioritize the interests of the customer under the consumer duty, but even if it did, I think the point is that you wouldn't have the same consequences on breach. And in any case, you must remember it's just a regulatory duty, so it's not echoed in the common law. And right now, but this position is likely to change, I think, in a few years' time when the banks have got used to it. They're giving an easing in period. Right now, the duty is not going to be privately enforceable. I think it will be enforceable by the regulator, who can sanction banks that they consider to have breached it. But many of the other rules in the financial regulatory framework are privately enforceable, but the consumer duty is not right now. Ruth, maybe you can tell us about excluding fiduciary duties in Israel?
Yes, this is a very good point. Because the fiduciary duty is so wide and so entrenched in our case law, there is no a possibility of waiving broadly the fiduciary duty. However, there is a slight possibility to contract out various specific components of the fiduciary duty. For example, both of you referred to a situation of conflict of interest. So even under the Israeli fiduciary duty, in certain situations, the bank, of course, firstly, the bank should try to avoid acting in a situation of a conflict of interest. But in cases where, nevertheless, a conflict exists, then, as you mentioned, Sandra, the bank can disclose the situation to the customer and receive consent. And under these circumstances, the bank may nevertheless act in a situation of a conflict of interest. Also, if we speak about the duty obligation of disclosure and explanation, which is a very stringent duty to explain to customers the full repercussions of a transaction, of a mortgage, for example, this imposes a very strict onus on the bank towards the customer. So here, the case law tried to flex on a little bit the duty, and if the customer is a sophisticated customer, so the level of disclosure or the level of explanation would be lower, of course. So even under the Israeli model, there are some mechanisms to soften the duty a little bit, or to contract out various specific components of the duty.
Okay, Matthias, any question from your side?
No, just to react to what you said, Christos, in between our presentations, the repercussions of all of these duties and of MiFID especially on private law relationships, that is of course one of the most difficult problems that we have in Europe, because it's different in every member state. And I don't want to go into even the details, just to mention that this is also not so clear. So when I presented MiFID, you were right. I was talking about administrative rules that are sanctioned by the supervisor, and not properly private law rules. But many courts in the EU, at least I understand it, for instance, in France, they take these also for private law purposes, and they derive private law consequences from them. Others do it a little bit differently, than rather on the basis of the duty of good faith.
So we have already two questions in the chat, and I will raise them here. The first comes from Daniel Gluck. Hi, Daniel. It's addressed to all panelists, but in particular to you, Matthias, because you have a recent book on that, yeah? Article 3, Paragraph 1 of Directive 93/13 on unfair terms in consumer contracts states that a contractual term which has not been individually negotiated shall be regarded as unfair if, contrary to the requirement of good faith, it causes a significant imbalance in the parties' rights and obligations to the detriment of the consumer. Oh my God, what an article, yeah? This provision has been heavily relied on by the Court of Justice to invalidate certain types of consumer credit contracts, in particular mortgage credit contracts in foreign currency that became a popular financial product in some EU jurisdictions. Apparently, references here made to the Swiss franc loans, which was also a very interesting issue, a heavy issue in Greece, and remains. Do you see here an avenue for imposition of quasi-fiduciary duties under EU law in bank consumer relations?
So if I shall give it a go, thank you very much for the excellent question, and it really falls into my ballpark, as you said, because I just published this book with Danny Bush on unfair terms in banking and financial contract, and I would violate my duties towards Danny if I wouldn't mention the book. So I mentioned it here, and we had reports from 17 different states, also including UK and Switzerland and Norway, so non-EU member states as well, but especially European member states, where we discussed this, and we looked at the Court of Justice case law, and it's extremely strict on banks. However, I would still say there are some very essential differences that I would see, and I don't know whether Ruth and Sandra agree, but I think this directive is already in its conception quite different, because first of all, it doesn't apply only to banks or fiduciaries, it applies to all consumer contracts. Second, as I understand the fiduciary rules, they are mostly about conduct, whereas here it's about the terms of a contract. So this unfair terms directive really allows the courts to police the terms of a contract, control them, for the standard terms, of course, only for their fairness. And as I understand, that's not necessarily an essential aspect of fiduciary duties, although perhaps it may be. You said they cannot be excluded, fiduciary duties cannot be excluded, but here this unfair term is really, or unfair terms control is really a standard that is used to control every term of a consumer contract, except for the main obligations and the price. So that's a second difference. And then the third difference is the consequences are also different. The fiduciary duties, as I understand it, a violation usually results in damages. In the case of the unfair terms directive, the result is usually the invalidity of a term. So these are the differences. But where I agree with Daniel is that the Court of Justice has really extended and interpreted this directive in a very, very far-reaching way, and derived from it some obligations of the bank where you are actually reminded of fiduciary duties. For instance, Ruth mentioned information duties of disclosure, and also a duty of explanation. So indeed, there are some cases where the Court of Justice said those foreign currency loans that Christos mentioned, you have to explain to the customer what this actually means, what are the consequences, and so on. Quite unusual. And they did that, of course, specifically with regard to these contracts concluded with banks. And some of the reasons that you cited for fiduciary duties, they may have played a role here as well. But still, legally, I would say the scope of application and the consequences are quite different from fiduciary duties.
Anything to add, Sandra, maybe?
Well, I would endorse what Matthias has said. The UK in their Consumer Rights Act has a provision to that effect. It was based on the same EU directive, the common law is a skeptic of fiduciary duties in the bank customer context, but that clause definitely applies. So yeah, I don't think you can correlate the two, even if there might be some sort of even if there might be some resonance between the two. I don't think you can translate directly that this has fiduciary implications.
I agree as well, and I can understand the question because there is a tendency, as I mentioned earlier, not to confuse, but to mix together various mechanisms for protecting customers, bank customers. So this may be the fiduciary duty and the duty of care and good faith and unfair contract terms legislation. But as Matthias said, each of them refers to another situation. And if we speak about unfair contract terms, we actually deal with the content of the contract, and it doesn't have to do with obligations or duties or prohibitions imposed on the bank vis-a-vis the customer.
Thank you. We have a second question here from Hussein Nabilu, who claims he came late and maybe he didn't get all the presentation, apparently yours. And then he says that I realize that the topic is very broad. And then, interestingly, has there been any case where these wide fiduciary duties have come in conflict with other duties of the bank, such as confidentiality, and how the courts have treated such a case? And in the same vein, I would ask whether the principle of suitability is also subsumed into this. Matthias was mentioning before cases of derivatives, and at the time he was speaking, I was thinking of the cases on Metallgesellschaft, yeah, and then the Orange County, which were based on the suitability. So is the suitability doctrine covered by this duty of loyalty or duty of, as we mentioned before?
Yes.
Ruth?
So I would like, first of all, to mention, to refer to Hussein's question.
Yeah.
And actually, there is a very famous precedent of our Supreme Court dealing exactly with this issue, where the bank owed two conflicting fiduciary duties to different customers. Sandra also mentioned the case of Wood, which is very similar. Actually, the bank found itself in a situation where it owes conflicting duties, obligations to different customers. And indeed, the Israeli Supreme Court accepted the idea that there may be situations where the bank would not be able to totally refrain from acting in a situation of conflict of interest, and the solution is disclosure plus consent. If you disclose it to the customer, you receive their consent. So this supposedly is a solution for this situation. And I agree with you, the wider the duty is, so more situations of conflict of interests may happen.
Okay, thank you.
Now, regarding the suitability, I'm not sure that I understood.
Would you wait for a moment, Ruth, because I see that Daniel is leaving, and he thanks us all for this seminar. Yeah, it was great, but he added here, just for the also for the other participants to listen, that just to add that civil law damages are part of consequences of breaching implementation of the directive imposed by some national courts. So this happens in jurisdictions like Poland, where the division of fiduciary duties and duty of good faith are not so clear-cut, and other jurisdictions as well, I would say. Yeah. So before we go to another two questions, Ruth, you wanted to say something on the suitability?
Just to say that I'm not sure I understood what you mean by this suitability.
You have the principle of suitability, which requires that whenever you choose a product for your clients, and this is mainly, I mean, the case law that I know of, and we have this principle in MiFID again, goes to derivative instruments, to financial instruments, yeah, but it can be broader, yeah, it can be to any product. And the suitability test is whether this is suitable according to the specific needs of the client, meaning that you need to have a profile of your client, which apparently in Israel you must have, yeah, in order to propose to him or her or it, if it's a company, yeah, the one which is most appropriate to its specific needs. That's the point.
Yes, yeah. So of course, under such a wide fiduciary duty, there is an obligation of suitability. And actually, I mentioned it very briefly in my lecture. I referred to the huge gap between the parties as in regard of knowledge and understanding. And I mentioned that this is exactly the concern, that the bank would take advantage of the knowledge and understanding gap between the parties in order to convince the customer or to push to the customer product or service that does not really meet his needs. And we see it very strongly in the field of credit, where banks and credit card companies try to push loans to customer, and in some cases this led to situations of over-indebtedness of customers. So of course, the suitability is a very important obligation under the Israeli fiduciary duty.
Okay. I thought so, but I wanted to make sure. So my dear colleague in Athens, Nikos Papaspirou, he's spoiling his day. This is his name day today to listen to us, but still he's with us. Hi, Nikos. And he's asking, I think this goes mainly to Matthias, isn't there a deficit in conceptual and normative clarity in civil law using a single good faith principle for a garden variety of purposes? And then I will ask just the opposite to Ruth.
Yes, of course, you can say that. I mean, it's a little bit overextended, the principle of good faith, and it's used for all kinds of purposes. And as I said, it can be stronger, it can be lighter. So perhaps it is worth thinking about introducing specific categories. I already mentioned the duty of loyalty in corporate law, which is kind of different and is in some respects stronger. But maybe we should indeed think about situations in the civil law where we there in specific situations demand have stronger standards and demand compliance with stricter standards. And I could definitely think that bank relationships are one of those, but also in much stronger, probably even portfolio managers and things like that. We could perhaps need a different concept, yeah. But it's difficult to introduce once you are path dependent on the way that the civil law systems are.
Thank you, Matthias. Ruth, another question for you by Nikitas Bobotis. If the Israeli fiduciary duty is also applicable at the same extent and force to other non-Israeli banks that have custodian and sub-custodian agreements in place with Israeli banks with respect to fund administration services.
Well, in Israel, we have very concentrated banking system, which is comprised of the 5 very large Israeli banking groups. And the activity of foreign banks is actually non-existent. It is very, very minimal. I'm not familiar with any a case that dealt with imposing a fiduciary duty on non-Israeli banks. And this is a very interesting question. the non-Israeli banks that operate in Israel do not offer their services to the Israeli population, but they work more or less like representatives of foreign banks, especially in the field of private banking, investment banking. So I'm not sure that under this situation, such a wide fiduciary duty would be imposed on these banks under this reality.
Okay, great. So if you allow me, I will try not to be provocative, but still, I have a kind of conceptual issue here that I would like to raise. We are all living in liberal economies, yeah, with some degrees of intervention and regulation, and we call it in Central Europe ordo-liberal or whatever, but still, you are based on the freedom to contract, yeah? And I understand you raised that very well. Your presentation was excellent in presentation and in content, of course. You pose the key problems, yeah, which are the cognitive biases, which are the information asymmetries, which is the unlevel bargaining power, correct. At the end of the day, what my question is about is, what about personal responsibility for the individual in that respect? Yeah.
Yes.
If you create all these extremely heavy, yeah, you said it, yeah, framework, what is at the end of the day the private responsibility of even the unsophisticated person who needs to be protected more than the sophisticated? And what is the role eventually in that respect of financial education? Because I have always considered that a higher level of genuine financial education could overcome a lot of the problems which we are facing. Yeah, because you don't need to have all this panoply of obligations in order to protect someone who really does not understand what is the difference between a bond and a stock, what is the difference between a deposit and investment product. Yeah, so it's more a conceptual issue that I raise here.
Yes, this is a very important point, and in my future lectures, I will add a slide on this point. On the one hand, the Israeli courts imposed a very wide fiduciary duty on the banks, but at the same time, the Israeli courts reiterated again and again that the bank is not the guardian of the customer, and the customer still has responsibility to manage his affairs himself. The customers cannot blindly rely on the banks, and we see it in many situations where customers, for example, lost money, claimed that they did not understand, that the bank should have warned them, etc., etc. The courts dismissed these cases and ruled that it was the responsibility of the customer to look after his own affairs. So actually, there are borders to the bank's fiduciary duty. In my lecture, I had only 15 minutes, so I wanted to focus and to let you understand the wideness and broadness of the duty. But at the same time, there are borders to this wide duty. First of all, the idea that the customer still has to manage his affairs by himself. Secondly, as I mentioned earlier, the bank is not supposed to totally neglect its interest, and we spoke about situation of conflict of interest. And thirdly, and also I think that Matthias referred to it speaking about the European law, even under Israeli law, the fiduciary duty is considered as a dynamic duty. The level or the intensity of the duty changes from case to case according to the specific circumstances. And therefore, in some situations, the fiduciary duty would be narrower. So I think that when we see the whole picture, there is a relatively good balance between the responsibility of the bank and the responsibility of the customer.
Okay. Thank you for that. I will correct you on something you said. You said in my lecture today, unfortunately, we didn't have time that all three of you make lectures today.
Short
But
presentation.
it was a short presentation, so I keep in mind that we need to make that in terms of presentations because it was extremely interesting. I will take another two questions from the audience. The one apparently goes to Matthias, and the last one will go to Sandra. And then, Ruth, you will have the privilege of concluding and telling whether you enjoyed it. Yeah? Now, the 93 directive refers to the drafting of contracts applying to all customers. This comes from my dear friend Thodoros Kouchoubas. Fiduciary duty refers to the behavior of the bank to individual customer in particular case. Is there any difference?
There's a huge difference. As I said, that's precisely one of the differences. The directive is not tailored to bank relations. It applies to all business to customer contracts. At the same time, it's a directive on standard terms control, and fiduciary law is about much more than just standard terms control. Daniel mentioned that some courts derive damages if you use unfair terms, but that's rather unusual, I must say. The typical and also the consequence that is foreseen in the directive is invalidity of the term. And that's also a little bit unusual, I think, for fiduciary law to say we invalidate terms. That's not what fiduciary law does, if I understand it correctly.
Thank you, Matthias. And then Stefano Montemaghi has here a question. I refer to climate-related litigation against credit financial institutions. We already have that, yeah. I was wondering whether, especially in common law jurisdictions, Sandra, the fiduciary duties doctrine might or actually have played a concrete role in this field. I think, for instance, of the situation where the customers of an investment firm allege that the environmental considerations have been omitted in a way which is inconsistent with the prospectus declaration.
So first of all, I don't think this is bank specific, right? So we're speaking more broadly now. It's well established that the directors of a company owe fiduciary duties to the company. Whether a failure to observe or to be true to good environmental policies or to ESG can be considered a breach of a director's fiduciary duties. I think that is still a developmental area. I think academics might be arguing for that, but of course academics can always make arguments which are not reflected in the law to try and flag how the law should be developing. But I don't think that currently reflects the position of the law. It's a potential area for development in the future.
Thank you so much.
If I may also refer to Stefano's question about climate-related litigation, well, the Israeli courts went even further and in some situations imposed a fiduciary duty not only towards a specific customer, but towards the general public, the public as a whole. And this, to admit it, I do not really understand what does it mean, a fiduciary duty towards the general public. But nevertheless, if we take this notion, which was expressed more than once by the Israeli Supreme Court, so maybe by virtue of this fiduciary duty to the general public, banks should refrain from providing credit to businesses that, for example, pollute the air. So this is a topic for further thinking. this relates to Stefano's question.
Great. I will give you again the floor, Ruth, to say the final word. I would like to thank you all for this. I think it was an excellent discussion. Yeah, I very much enjoyed it, including the questions by the attendees, who we should also thank because they were the one better than the other. Yeah. Let me also thank Claudia and Ricarda for all the work that they have done these last weeks to prepare and support these events. We know now that we have 3 very knowledgeable speakers for future events. We have learned, personally myself as well, that we should never invite Ruth to speak about the Israeli deposit guarantee scheme because there is none. But again, we would love to have her on any discussion about this genuine Israeli model, yeah, which can give a lot of thoughts, yeah, to people how it could be exported. Yeah, I don't know whether this is an exportable good. This is another question. But thank you so much for all this, and let me give you the floor to conclude, Ruth.
So I only want to thank everybody. It was really very interesting academic debate, and I myself studied a lot from my colleagues and from the questions of the attendees. So just to thank everybody.
Great. So see you soon again. There is no other event foreseen for the next days of the EBI, but there is a, come on, it's Christmas, by the way, and then New Year's Eve, so we need to relax a little bit. But then in January, we'll have a lot. Just to let you know that on the 30th of January, we'll have the presentation, an academic debate with the presentation of the book, the new book of Filippo Annunziata on market abuse and artificial intelligence. In February, we'll have our global annual conference in Frankfurt. In March, we'll have a book launch of the presentation of the new book by Dirk, Douglas, and Ross. And if Matthias and Danny wish, we could have also the presentation of their book. Even though I know that you will have another one, a very prestigious one in Oxford. I have been there with Danny on a previous occasion, but if you wish, we can organize it
That would
also.
be nice. Excellent idea. Thank you for that.
Yeah,
I will discuss it with Danny.
Share it with Danny, and I would be more than glad if you were to decide to have, because you see, this is a different setting, and we could have more people who would not come to Oxford, so it would be great to have you there, and we will invite Sandra and Ruth to be your discussants in that, yeah? Okay, great. Thank you all very much.
Thank you
Have
all.
a nice evening, and see you soon. Bye.
Thank you.
Bye-bye.
Thank you very much.
Bye.
Bye.